How do you go about diversifying your stock portfolio? Many people out there think that diversifying is just increasing the amount of stocks which an investor is holding. That is not accurate. There is a method to ensuring you are diversifying in the appropriate way that ensures your portfolio is healthy. That's why in this video, I want to share with you 7 rules which can help you diversify in the appropriate way. We're going to look at these rules, and by the end of it, you really have learned key information and key concepts which are going to assist you diversify in a healthy way. By the way, in case you are new here, my name is Afagza Sifuna. I am a finance expert and qualified accountant, bringing you videos about making money and investing each and every day. In case those are kind of topics which you like, down there is a button called subscribe. Click that button and consider subscribing to this channel because I'm uploading amazing videos each and every day and you don't want to miss out on those. And while you're still at it, drop a like on this video. Thank you for subscribing and dropping a like on this video. Having said that, rule number 1 you need to follow is that diversify across sectors. Taking an example of the Nairobi Securities Exchange, under equities, which is an asset class, specifically under shares or stocks, we have 13 sectors, okay? Ranging from automobile, agriculture, commercial and services, banking, investment, all the way to even ETFs. A healthy portfolio appreciates diversification across sectors. Case in point, in case you are holding shares of 13 companies, okay, and all these companies are maybe in services, or even 90% of them are in banking, that is probably not a healthy portfolio. That is why you need to consider diversifying across different sectors. And then, rule number 2 for you is that you need to strike a balance, okay? Ensure you balance between growth stocks and dividend stocks. Growth stocks are basically those stocks which have the potential to give you very rapid share appreciation, to grow at a much faster rate compared to the stock of mature company. At the EABL, the good thing that we have a mix of these companies, right? We have growth stocks and also we have dividend stocks. Dividend stocks are, for example, those companies which are mature. Think about the BATs, EABLs, okay? They have been there for a while and they have been paying dividend over time. So they don't have lots of upside when it comes to share price appreciation, but then again, they have been consistently paying dividends. And then we have other companies which have the potential to grow very rapidly, right? Think about, for example, companies like Krishna, even for example, Shri Krishna, which was listed last year, okay? It has potential to grow very rapidly in its stock price over time. Think about even the banking sector firms which are doing rapid expansions in the region. All those constitute growth stocks. So ensure you strike a balance between these two, and that way you're going to have a healthy portfolio which is going to enjoy both share price appreciation and also the upside of you getting dividends, okay? And then the third rule for you is that own stocks of companies of different sizes. Guys, beyond sectors, beyond the type of stock, also you owning stocks from companies of different sizes is going to ensure you have a sweet spot between stability and the probability of you growing very fast. At the NSE, we have those large cap companies, okay? Then we have mid cap and small cap companies. Aim to have a mix of all these, because through this mix, you're going to enjoy all the benefits of stability and the potential for you to grow. So aim to ensure you have stocks also from companies of different sizes as you are building your portfolio. And then the fourth rule for you is that don't let one stock to dominate your portfolio. What do I mean? Yes, out here you are encouraged to build a portfolio, okay? Constituting different stocks or shares. which is amazing. But then again, don't let one stock from one company dominate your portfolio. Case in point, if you have, for example, portfolio constituting 10 stocks, right? And then maybe one stock, let me give you a random example. Maybe one stock of, let me say, for example, a company like maybe Samia Africa or even Everready, right, is constituting 90% of your portfolio value. Guys, that's a risky affair because that one stock which is dominating your portfolio, in case something happens to that particular stock, is going to mean that the net effect on your portfolio is going to be commensurate to how that individual stock is going to perform, because the other stock which amount to less constitution in your portfolio won't be able to even any negative impact on your portfolio. That is why you need to be evening and balancing your portfolio periodically to ensure that no one stock is dominating your portfolio. And then the fifth tip for you is that diversify across different investment styles. What do I mean? When I talk about investment styles, I'm talking about types of businesses, right? There are different types of businesses and they invest differently. Two specific examples are those businesses which do something called defensive business, and then the other one do something called cyclical business. Defensive business are those businesses which basically are going to continue thriving in the economy despite the economic situation. And to give you an example, even for example during COVID, right, when even there's shutdown, there are businesses which are going to continue thriving. Case in point, businesses in telecommunication. Case in point, key businesses in the fast-moving consumer goods. These are businesses whose products and services are needed by the population each and every day, and they can't avoid them because they are basic needs. Case in point, even during COVID, Safaricom continued doing very well because people need to continue making phone calls, therefore they require airtime. Okay? They need to continue using the internet, therefore they require data. They need to continue using M-Pesa, you name it. All these are going to continue being utilized by people out there despite the economic situation. Even when you look at, for example, fast-moving consumer goods, right? Those are products which are going to continue being demanded. For example, cooking oil, right? For example, washing detergent. In case this company, which is having those products as the main products anchoring their offering, that business is operating in an investment style called defensive business. Okay? They'll never be affected by the economy that adversely. And then on the other end, we have the businesses which we call cyclical businesses. Simply put, they operate in cycles. Case in point, a good chunk of companies in the agriculture sector are cyclical businesses. And I'm saying so because at global level, there's typically determination of prices of agricultural commodities, where prices go up and go down. Okay? And even beyond that, also matters around climate. Okay? Climate also does impact such kind of businesses. Because in case, for example, the weather is bad, most likely the produce of these businesses is going to be low. If they are low on production in a given year, that is bound to affect even their stock. That is why you need to balance between the different investment style, right? Balance between defensive businesses and also cyclical businesses, okay? And then the sixth tip for you as an investor is that aim to invest gradually as opposed to putting a lump sum amount in the stock market, especially when you are starting out. And I'm saying so because the biggest risk an investor will get into is them investing and making decisions based on emotions. In case you are investing gradually, simply utilizing techniques like, for example, dollar cost averaging, where maybe even if you want to invest 1M, you can say, I'm going to invest 100K every month over the next 1 year. That is going to remove pressure from you to be waking up to look at your portfolio and stock prices each and every day, each and every hour. You got to just be pumping 100K every month to the stocks and adding to your portfolio, which is going to be an amazing thing for you to do because it reduces risk and also it is a healthy thing for you emotionally. Therefore, you'll be able to build a portfolio in a healthy way as opposed to you going for risk, very high risk, which you're not sure about, and also putting yourself in a situation where you end up acting emotionally, okay? And then the seventh and final tip for you is that have regular review of your portfolio and do rebalancing wherever it is necessary. Just because you've constituted a portfolio, it doesn't mean you've determined it for life, right? Investment goals across different portfolios or companies do change, right? Even based on the growth in the market, maybe the sizing of your portfolio across the different stocks might have changed. So have a standing cadence, if it's, for example, quarterly, annually, where you have a deep dive and review how your portfolio is doing to determine the course of action which you need to take so as to ensure you continue constituting a healthy portfolio. That review is going to really assist you ensure you maintain a healthy portfolio. Guys, those are 7 tips which are essential for you to constitute a healthy portfolio and, most importantly, continue maintaining a healthy investing portfolio. What do you think about these tips? I hope you grab some of them which you're going to implement, and hopefully they're going to help you be able to ensure you are maintaining an ideally constituted portfolio. Cheers, guys, and you all stay safe.